Good afternoon, welcome to Market Wrap number 127. Only 37 sleeps till the big guy Santa comes down the chimney, and only one day till the Chancellor presents his budget in the UK. Certainly Santa is generating a lot more excitement in our house, and hopefully the Chancellor's statements will be less exciting and earth-shaking than Mr. Quasi-Quateng's. With the election of 2025 on the horizon, the market view is that the areas that don't vote will be most targeted to raise the billions, 50 billion that's needed, i.e. companies, windfall taxes and some capital gains tax changes to second homeowners, which shouldn't be too onerous. Thank you for watching this. It is a Market Wrap. We do this to share information in a short format to our time weary and life weary clients and people who are thinking of investing. Please do subscribe, like, listen to our podcast if you get a chance. They're completely different topics and are hosted by a far more interesting and knowledgeable person in the name of Paul Shearer, the renowned financial journalist. This week I'm going to talk about, are interest rates falling? Is it true? Is the UK residential market really going to go pop? Mortgage rates could fall below 4% by the end of next year, as central banks are expected to peak lower with their rates. This is according to Apple News from yesterday. Rates on fixed mortgage deals are expected to fall below 4% as soon as early next year, according to Apple, as several lenders have reduced their rates again this week, despite the Bank of England raising its rates 0.75 points to 3% earlier the month. Many lenders have priced in even bigger hikes than the 4.5 that's on the horizon, looking at 6% after the mini budget. Now that the cost though of financing is reduced for high street banks, thanks to the gilt crisis coming back under control, that's GILT, not GUILT, and confidence being restored in the UK economy by the new Chancellor and Rishi Sunak. Lenders are now starting to reduce mortgage rates because the fear factor is going out of the marketplace. Excuse me. While tracker mortgages have followed the bank rate rise, fixed rates are continuing to fall from the highs they reached in September. The average 2-year fix, which peaked at 6.65% on the 20th of October, now sits at 6.28% as of the 14th of November, 2 days ago. Whilst the average 5-year deal, which peaked up at 6.51%, now sits at 6.07% according to Moneyfacts. Platform, Yorkshire Building Society, HSBC, the Halifax, Lloyds and NatWest have all reduced their fixed rates in the past week. The 5-year fix offered by Platform, which is the lending arm of Co-op Bank, has a rate of 4.84%, making it the first time a lender has released a sub 5% deal on a 5-year term since the mini budget. Okay, that's fantastic. First Direct launched a 4.99% fix last week, but it's on a longer 10-year deal. Nationwide also currently offers a 2-year fix at 4.84% and a 5-year fix at 4.64%, but these deals are only available to nationwide borrowers. Now bear in mind, these are UK onshore rates, not offshore, so it'll take a while for it to filter through to the offshore. Experts, that's not me, these are experts, people who know, predict that rates could come down even further, as the markets are now expecting to raise the central bank to a peak of 4.5% next year, somewhere below the expectations of 6% when we were all saying the end is nigh after Quasi-Quateng's Liz Truss's adventure. This will mean that mortgage borrowers who need to rearrange their home loans next year will not face such a steep increase in payments as previously feared, which is self-evident really. Mark Harris, who's chief executive of the mortgage broker SPF Private Clients, said that pricing of fixed rate deals had been edging down in recent weeks. He goes on to say, if this continues, we'd expect 5-year fixes below 4% by early 2023. Meanwhile, some lenders are also guaranteeing their mortgage offers for up to 12 months in order to better support their clients. This is important for us offshore because if you're in Beijing trying to get a mortgage done after all the complications of getting things translated and so on and so forth, getting up-to-date bank statements. Often you have to start it all again because it's all gone out of time. So these are things are important, and it's also important in the UK if people are doing new builds, because that can be quite a delay on that, with delays in finishing and so on and so forth. Matthew Jackson, who's director at the mortgage advisor Mint Financial Services, so the change will probably provide, I quote, an all-important certainty when certainty is in short supply, which is fantastic. Great quote. Thank you very much, Matthew. So there we go. Things are easing, and it is getting better. Now, next question is, was the October dip in house prices a blip, or was it the end of the world is nigh? Start of a correction. Knight Frank yesterday brought out their latest report, and they review all this. Okay, now you're about to say Knight Frank and myself have got access to grind. Yes, we have, but I always look at the positive, and normally it's time in the market, not timing the market. Okay, for the first time since 2020, house prices have fallen. Bank of England have dropped the number of mortgage approvals, and the number of new UK house buyers registering has fallen for the first time since May 2020. Okay, you've got those sort of things going on. You might reasonably allow the markets, the general public, to conclude that a period of robust house price growth, which began in the summer of 2020 when COVID started, is turning into a nosedive, as many of those who watch this channel believe. You know, this week I had a client write to me saying he's expecting a 50% drop. Halala. But things rarely happen suddenly in the UK housing market. The October dip, we believe, was almost certainly magnified by the impact of the mini budget and the accompanying mortgage market volatility, which has now begun to recede. Buyers hesitated, asking prices reduced to allow for that. We saw that very much offshore. People going, oh, I don't want to do it. No, it's all going wrong, especially so far away. But in a market as illiquid as residential property, where so many buyers are needs driven, whatever happens next will be more gradual. You know, unlike the global financial crisis, there's no reason to think we're at a cliff edge here and we're going to fall off it and house prices will tank. Despite what people right now, they're writing and say I'm a simpleton, I know nothing, look at the figures, look at this, look at that, and I'm talking rubbish. The Bank of England said mortgage approvals had decreased significantly, oh God, to 66,800 from 74,400 in August. But was this really a massive shock decline? No, the figures for September was higher than the monthly average for the last 10 years. In addition, the transaction pipeline is still strong. Some transactions may fall through, and they are doing, but the pipeline going into the final quarter of the year is in good shape. In fact, the number of offers accepted across the UK in October was the 10th highest figure in a decade. So people are still out there, and it's not because they're ignorant or stupid. You know, not everyone is buying into this the end is nigh story, and it's very much geographical. You know, some people are motivated by the fact that rates are rising. You know, they've brought forward the decision making. Let's get in while it's cheaper. You know, there's a great link to an article at the bottom of this piece in the Telegraph where they went into the Freedom of Information Act and they asked where were the places with the least equity in properties. That is where you're going to see a sell-off, not in the equity-rich city centres. It looks like house prices will come under more pressure after Christmas as the impact of higher interest rates and mortgage rate spreads. This doesn't mean that we're going to have people being bankrupted by banks. They don't want the property. It takes 2 years to bankrupt someone and get them out of a property. Banks don't want to do that. Very negative aspect. People see it very negatively. We're not expecting to have a wave of forced selling, precipitous bank declines. You know, lenders for a start are more insulated than they were during the global financial crisis. Mortgage capital and interest payments as a percentage of income at the moment are 17.7% compared to 23% at the end of 2007 when there was massive unemployment going on. Hello, he's not invited. After house price growth of 25% during the pandemic, negative equity is also more limited. More people also own a home than 10 years ago. The figure was 8.8 million or 36% in 2020 compared to 7.3 million in 2012 from the ONS. There are large geographical overlaps between those areas of the country where more property is owned outright and our analysis of which locations have the highest percentage of cash buyers. A group of people who will be far less impacted by rising rates. Reading the article from the Telegraph Freedom of Information Act, where will the biggest hits be? And you'll see it's the places where they've got 5% down and they bought right at the end of the market. You know, JP Morgan, 75% of people buying the top 25% of the market. That's how it happens. Furthermore, supply is still around 25% below pre-COVID levels, which will keep house price declines in check. This will be more noticeable if discretionary sellers hesitate whilst the market stabilises. They don't have to sell, they'll think about it. So to be fair, and okay, as again, you can say what you want, it doesn't feel like to me like a rerun of the GFC, when prices dropped 18% in the year to February 2009. Instead, I think the housing market is just being somewhat erratic on its way back to normality. The next bump in the road could well be today's autumn statement, as they call it. But I don't think we're going to see we're not going to see Rishi Sunak doing the same thing that Liz Truss did. You know, they're going to keep the market calm and focus on who aren't the voters in the next election. So less of an impact on people who are going to be remortgaging and looking to sell their houses or buy new ones. Okay, let's briefly look at inflation. The report came out today. It's 11.1% in the year to October, up from 10.1% in September, according to the ONS. Rising energy prices are being blamed. If you look at the graph here, the housing and household services bar, the chart below, you know, you'll see that's what it is. Although food costs also rose substantially. How this is going to affect the government's decision making, or the Bank of England's decision making, I don't know. But when you look at the rest of the figures out there, the data in the market looks pretty benign and not that bad as it was around, you know, the Kwasi Kwarteng experience. So inflation pressures are clearly easing across a range of key sectors. Below, I put below the actual links to different articles, which I've not done before, but you might find it interesting. There's one from Apple here. There's also one about the Freedom of Information Act from the Telegraph you might look at. There's one about house price rentals increasing at the greatest rate for 10 years. So some good articles there. Please do have a look. Please do subscribe. Thank you for listening. I hope you enjoyed it. Please say if you don't. No doubt you will. Please subscribe and do fill in the form below if you'd like more information. And go to the podcast. You know, Paul Shearer is great. Really knowledgeable bloke. Went to Cambridge. Intelligent. Okay. Bye-bye.